Good evening, everybody. I was just telling Price that I don't mind the snow up here. I got the fire going. Sandy's in Corpus visiting grandkids, so it's just me and the cat. The only thing that I didn't do is send the cat with her. So, anyways, today we got the great pleasure of having Price back with us. And I say great pleasure because in the years I've been trading and doing presentations around the nation, Price, as you can see in the what I put in here, he is one of the most respected technical analysts that I've run into. And he is down to earth, straightforward, teaching you techniques that are very easy to understand. So I have the highest respect for Price. We like having him back. So with that, Price, good to have you here. We're anxious to see what information you got for us tonight.
Oh, well, thank you so much, Steve, and good evening, everybody. Price Headley here, CEO of Big Trends, and it's always a pleasure to be back with the Candlestick Trading Forum group. Steve and I share a real similar passion for education. Really, it all starts with education. So I'm going to give you an overview tonight on the indexes. You know, we got the big indexes hitting record highs. You would think that everybody would be really optimistic about where the market was headed. Out of curiosity, I've got my lead consultant, by the way, Chris Sarin, with me, who's helping answer some questions you might have in the chat box. I want to ask just a quick question before I start. If you were going to say, is the market going to be higher or lower at the end of 2017 from where we are right now, what would you say, higher or lower? Just type an H for higher or an L for lower. I'm just curious how many bulls and bears we've got. Okay, so I see maybe a few more H's and L's going across there. Maybe a few more H's. Okay. So a little more bullish. You all know how to read the charts, apparently. Okay, that's a good sign. The charts have been bullish, as you know, for a number of years. And at the same time, of course, so we'll be buying opportunities along the way. And whether we go up or down, I want to show you how you can profit from it in each direction. So, but definitely interesting to see. Okay, I expected to see a little bit more mixed reaction, but I think Steve has done a good job to train you all on what a trend looks like. So I'm going to show you that as well. Just a reminder, of course, that everything that I share with you here tonight is for your information and education only. Nothing that we talk about here should be considered a specific recommendation to buy or sell any particular security. And of course, you know that ultimately you are the one who's solely responsible for your own investment decisions. Big Trends and the staff aren't responsible for any trades you choose to make, and not all Big Trends products or services are going to be appropriate for all types of investors. So consider your risk level as you go through this and see what's right for you or not. But basically, the big thing that Big Trends doesn't do is we don't provide any personalized one-on-one financial, tax, or legal advice. We put all of our research out to groups of subscribers at the same time, then you decide how you want to use it. And do consult your tax advisor, too, before you make any investment that's going to impact your unique tax situation. Okay, so what are we going to talk about here tonight? The big four indexes. This SPY, as you know, is the biggest, the S&P 500 ETF. That's the first one that we started with when we did our index options trading, but then we've added in a few others. The bond market, the TLT, the gold miners stocks, the GDX, we actually like that better than the GLD gold bullion, and the IWM, which is a Russell 2000. I saw somebody posting earlier the Russell 2000 was up some more after hours in the futures market. And we're going to talk about how you can do it one of two ways. You could do it directionally with calls and puts, buying a call, buying a put. You could also do it, as you'll learn from our boot camp later on, I'll tell you about that. You could do it as an income strategy, selling premium too. So whichever way you like to do it, you can learn how to both buy and sell premium here. We try to keep it as simple as possible here at Big Trends. And bottom line is that what we're going to also talk about is a very unique two-step process. One is a setup on the longer term daily chart. The other is an intraday that is we call the trigger that actually then gets us into these trades. So we'll talk about how you're set up for potential reversals and where the reversals occur within an evolving trend. And of course, ultimately, it's about cash flowing the markets. Everybody's always looking for more cash flow. We'll show you how we cash flow these big ETFs. Now, with the buying example, since the beginning of September last year, we took basically our selling premium ETF option system and said, what happens when we start buying options as well with that same one? So we're trying to make it accessible to all types of traders in options, whether you like to sell premium or buy. And we basically, across winning and losing trades, were able to take it up through uh, the end of January from 10 grand model portfolio up to 13,240. Now, just a reminder, that's gross profits before commissions. So you got to factor your commissions accordingly. We always tell people just, if you're expecting the neighborhood of about 8 to 10 trades a month, figure out, okay, what it would cost you to basically be in and out of a single leg in this case when you buy a put or buy a call. By the way, how many of you are trading options or not? If you're trading options, type a Y for yes. If you're not yet, hit an N. I'm just curious if most people are familiar with options. I don't want to bore you with too much option stuff if you know it. Okay, it looks like a few knows, but it looks like most of you are familiar with it. But even if you're not, you can easily implement what I'm going to show you here. I would say if you're just getting started with options, probably this buying strategy is actually the simplest way. We call that ETF options trader. Tonight I'm going to focus you more on the education, how you can start really with an attractive entry point on our ETF boot camp, and then you can figure out if you want to buy or sell options down the line. Now, what are ETFs? I know most of you are probably familiar with it, but if you're not, ETFs are exchange-traded funds. The reason these became popular is because before exchange-traded funds really started to take off, you used to have to just buy mutual funds. Remember, most mutual funds only have one point of the day at which you get a price, and that's at 4 o'clock, and you don't even know what that price is until after 4 o'clock. That's not very helpful if you want to make a change in your fund exposure during the trading day, whether you want to add to it or take some off. So the beauty of this is now these exchange-traded funds trade just like a stock from 9:30 to 4 p.m. Wall Street time every single day. The big thing about ETFs that makes them more appealing to a lot of investors than stocks is that you can diversify across an entire sector, like say the tech stocks, the in specific subsectors like internet or semiconductors or whatnot. And then so a lot of these sectors, if you will, and then of course a lot of the commodities, whether it's gold, oil, bonds, and of course all the ag commodities now have an ETF for just about everything. The currencies, volatility, and of course just about every major country, international stock market around the globe has an ETF that tracks that country as well. So you could buy, the Turkey market or the Russian market or short it, whichever way you want to go. And that's the thing we're going to talk about here is that there's always these bull and bear trends happening somewhere around the globe. But what we've found is that when you start trading not just on the ETFs but on the options on the ETFs, you better be focused on liquidity. And so that's why this narrow bid-ask spread is so important. What that means is that when I'm getting in and out of an option, I don't want to have to pay too much of a differential, too much of a cost effectively for what I have to buy at the ask versus sell at the bid on. I want to see those spreads as tight as possible. And the SPY options are usually a penny, which is $1 a contract, which is the lowest they can be. So you get really small effective operating costs to get in and out of the SPY options, whether you buy them or sell them. And the same thing with these other big ones that I want to teach you about tonight. So the great liquidity, of course, is very important. They don't have, they're not actively managed. They have low expense ratios. So you're basically tracking the index about as purely and cleanly as you can track it. Okay, that's what we're after. Now, what I want to show you is when I do data testing in TradeStation. You don't have to have TradeStation to take advantage of this stuff here tonight and going forward, but the bottom line is that I've been using it since the early 90s for 25 years plus, and basically it shows me that if I took back 20 years of data here, back from the end of 16 going back to the end of 1996 here, I can see how would any system idea that I test do. And frankly, the SPY is a tricky one on most traditional systems. You'll find that essentially you've heard of the theory of the efficient market hypothesis. I'm sure a lot of you have heard of this theory that means that if the markets are truly efficient, that everything should be factored into prices as they currently sit. Now, if they were truly efficient, we couldn't develop an edge on a system over time that would keep making these new equity highs, these green dots on this chart with very little give back. And let's face it, going forward, I can't guarantee it's going to have the exact same profile. We know there's going to be trades that win and trades that lose, but what we're seeking to do is put the odds in our favor and ultimately in all of our big trend subscribers' favor as we take advantage of this. And another thing to keep in mind too is that if you don't like buying an option and losing time, one of the nice things is that when you go through, even on this system, some flat periods, I'm not going to talk about the straight up periods because you can see those too, but even when you see some generalized chop over a period of even 100 or a couple hundred trades sample, if you got caught in that, then basically you say, gee, I wouldn't make any money there. Well, guess what? I can show you when you sell premium how you can profit from those sideways periods as well. So the sellers of premium will actually have a higher winning percentage than the option buyers. The option buyers will actually make more when they catch those good trends than a seller will. So it's kind of a trade-off between if you're looking for more growth as an option buyer or more income as an options seller. Okay, now when we move it from the SPY over to the bond market, TLT, you would think, you know what? The bond market is huge as well. You'd think there wouldn't be a whole lot of opportunity there. Look at how steady over the last several hundred trades that bond market uptrend has been as it's just kept on charging to the upside. You can see it had a couple of kind of dramatic dips in between, so it's not as straight up of a overall steady equity curve. This is basically how you would build your portfolio. If you're trading 100 shares at a time is what we did, just going back and say, okay, do you make money on that underlying ETF or do you lose it? Obviously, when we use options, we can create leverage accordingly. If we go back and look at, say, a case study recently, of what we just traded here in late January. One of the indicators we like, this is going to actually a couple indicators I want to teach you about tonight. One of them on the left side of the chart here is the Donchian channels. Now, Donchian channels effectively measure, show me the highest high over a given period of time. That's the upper light blue line here. And then the lower line is the show me the lowest low over a given period of time. In this case, we actually changed the settings depending on the vehicle. We actually tested it backwards and then traded it forwards over the last 5 months to say, okay, are these settings still working across these vehicles? And they're working nicely. But they're different. So in some of them, that might be anywhere from 1 or 2 sessions of show me the highest high over the last 1 or 2 sessions, which is pretty easy to see. Some of them might last up to a couple of weeks. So you can see in this TLT chart, we're going back and looking at some fairly quick adjusting Donchian channels to start to measure, okay, where the support and resistance is in the market. What our testing said is that once we trigger down underneath a recent short-term key low, you would think that's a breakdown, but actually because there's so much noise in the major markets, our testing said you actually want to be prepared to buy that as kind of a quick head fake and catch it as it turns, if it turns. And so that's why the daily chart on the left here is what we call setup. And we will not take every trade that gives us a potential opportunity to buy into this. You can see that we did buy it the next day because this is on January 20th. Because you can see on the right, this is where we get into the trigger. This is now a 30-minute chart on the TLT. So we're using the intraday chart and we're using a stochastic to actually say, okay, if it's coming out of this very oversold area on the stochastic, and here it's actually coming out of it late on the 20th. That was a Friday. That was actually a third Friday expiration day of the traditional January monthly options. And we were saying, look, this is an opportunity to catch a turn to the upside. You can see it only lasted for about that afternoon into the next Monday for half of a Monday. But that was good enough the very next trading day, which of course was Monday, so we're not talking calendar days here, but trading days, for a 39.82% gross profit. Okay, so most of our model portfolio, we're looking to get invested up to about $1,000 and no more. So we can essentially simulate if you're doing about $1,000 a trade, you're making just under $400 before commissions, right? $398, and then you take your commissions out. You have to buy the call. In this case, the 117 call. Let's talk about that for a second. If you're buying the options instead of selling premium, notice when we buy a 117 call, where is the TLT trading at over here on the right? It's trading at the buy point when the stochastic crossed up around 120. Those that know options know that a call is a right to buy the ETF, the TLT in this case, at a strike price of 117. That intrinsically is already worth what at 120? It's worth $3 because you could theoretically exercise that option, go ahead and buy the TLT at the 117 price, and then sell in the open market at 120, pocket the $3 difference. Would you want to do that? No, because you see it's costing us $3.29 here on the top left. That's what we paid. So it's worth $3. Why are we paying $3.29? Because that's the time premium portion in which we're creating tremendous leverage for this small move in the TLT. You can see the TLT the next day went up to went from just under 120 when we got the buy signal to about 121. Not even quite a 1% move led to almost a 40% move in the option. That's a 40 to 1 leverage ratio. Now, leverage cuts both ways. This is why timing is very important. That's right, Rick. You're only paying an extra $29 out of that $329 a contract you'd pay to control 100 shares of the bond market TLT when it's trading around 120. Think about it. If you bought 100 shares of the TLT ETF, you know it's going to cost you 12 grand. So we're controlling 12 grand of the ETF value for $329 plus your commission. So basically, you say that's why less than 3% of the total ETF value is what it's costing us. That's why your leverage is pushing up at more than 33 to 1 and pushing towards 40 to 1 on that particular move. So, what we will do is we'll usually set a profit target, and then we'll also set a stop that's about half of what our profit target is, okay? Interestingly enough, you see it had another setup here on the 26th, but we were no longer quite getting the same kind of confidence in that Donchian channel holding the way it needed to, so we didn't quite get the same interest. We need to see both pieces. The trigger is part of it on the right on the intraday chart, but so is the setup. They both need to be happening. So the setup is finding a close below a number of bars back low, and then the trigger is then finding that reversal. Okay, that's the TLT. Now what about the gold market? You see GDX, this is the gold miner ETF. This is tracking the biggest gold stocks that you can buy as a package that make up GDX. You're talking about the big gold stocks like Barrick Gold, ABX, and Newmont Mining, NEM, and more. So you're buying a total package of the big ETFs, and then you're just trading the sector, in this case that commodity of the gold miners stocks, as one vehicle, GDX. That makes it real easy to say, okay, we don't worry as much about one stock that you wake up one morning and that stock fell out of bed against you and all of a sudden you're kind of panicked about it, right? Or worse yet, you're out of the game because it got a big gap against you. Sure, if one of those has a big gap for some company news, it's going to have an effect on the ETF, but the reality is most of these big ETFs don't have a stock that's more than 10%, a lot of times no more than 5% of the total ETF value. So you're basically spreading out your risk, and you're really playing more of the overall sector, in this case of the big gold stocks as a whole. And you can see it was a little bit of a bumpy start going back in this case to where we started to have data, which is about 10 years before. I said 20 years, but that one's actually only over the last 10 years. So I'm going to stop my projection here. Let me re-project here. And saying, okay, if we're looking at this, let's see if this works. Okay. That basically we're saying, okay, you can see there's this really nice overall equity curve growth and even accelerating a little bit towards the end. Remember, past performance is not a guarantee of future results, but we're basically saying we're using the testing to tell us that we're trading an edge over time. And the key that most traders forget when you say you've got an edge in your trading system, that doesn't mean that the next trade you place is going to be a winner. If we knew that, obviously, then we would never take a losing trade, right? But the point is that when it's like any probability game. It's like for example, if you played a coin flip game where you said, okay, you have a 50% winning percent with a fair coin, right? But if I told you that when you called heads, you got $200 in your pocket, and when you called tails, when you called heads and it came up tails, then it goes the other way. You get back $100. Would you play that game knowing it's a fair coin with a 50-50 shot of winning? Yes, you wouldn't put all your capital into the next trade, right? But you would definitely say, hey, think about that. If over time, if you won on half of your coin flips and you won 200 and then you gave back 100 when you were wrong the other half of the time, you're going to win an average of $100 over each of those two coin flips, or an average of every coin flip to you is going to be worth a plus $50 expectancy if you think of it that way. So that would be a game you'd like to play. If it was reversed, you wouldn't want to play the game. Unfortunately, too many people go to Las Vegas thinking they don't have that much of an edge against them, and very few people walk out with smiles coming out of Vegas because the odds are stacked against them. The longer they play, the higher the probability is they're going to lose. So we don't want to play those games. We want to play games where we've got a deck stacked in our favor. Okay, so when we see, for example, GDX, this is an interesting one because you can see GDX has actually had a big run to the upside this year. Remember, it lagged pretty well last year, had a big run, but look at this. We're actually catching it after that last run. By the way, notice on the right as it ran up, notice how our stochastic never got oversold enough. So that's an X. I would never take that trade because it doesn't likely have the staying power. In this case, it had a pretty good move. So we're going to miss some of those moves. For the higher probability move, in this case where when we got the overbought signal touching off and starting to flip on that Donchian channel in the upper recent short-term quick high, you would think, well, gee, that's the market that's breaking out. Why would I want to trade it? Because GDX has a nice reversal quality, and you can see that it actually pops down over the next couple of days. You saw it started to work in our favor, popped back up, you see it had a kind of jagged down and then a little back up, but then when it gapped down here that next morning, that's where we're saying thank you very much and booking our profit there just under $23 on the gap down. And so that turned in, again, off of a move where GDX started around 23.70 and finished just under $23. You say that's about, in this case, a move of about maybe 3%. And you can see our leverage not quite as great here, about 12 to 1 on the GDX, not 40 to 1. Okay, I can still handle 12 to 1 a couple days later. Notice it started to turn back up. Why didn't we go ahead and buy here when it started to turn back up on the morning of the 27th? Because look at where the support was on it. It was down below where the stock was. We were about 22.55, and we were only got down to about maybe 22 and 3/4, 22.80 really. So although it's support there. So we never quite got low enough to give us a buy coming back the other way. So we're very picky on these types of setups. And so you can learn more about this. I'll tell you how. But bottom line is that look at the Russell 2000. I mean, that's a really nice equity curve. Now, not just for buying, but even in those flat periods here where it's not going anywhere, you know what? Option sellers should be salivating. Remember, when you do option selling, you're just betting that's not going to make a big move against you. And so you can see that overall, this one hasn't had too many severe drawdown periods. It's been either up or flattish. And so that's going to be really good, not just for option buying, but also for option sellers. Most people that do option selling a lot of times think about the S&P 500. It's got 500 components. Guess what the Russell 2000 has? The small cap average has 2,000, as the name says, 2,000 components, with none of them more than about 2.5% at the peak. So you don't have any big stock like, say, Apple in the NASDAQ 100, QQQ, is making up 10% plus of that index. That's too much for me. So we've stayed away from the Qs, even though they've done fantastically this year as Apple's come back up. That's wonderful. But it's not the kind of stability that we're looking for. We're looking for greater stability than that type of impact of any one stock. That stock has a bad day, you're going to have a bad day in the Qs as well, or vice versa. So that's what we're looking at here. Now, over, in this case, going back 16 years, you can see that you grew from $0 up to over 22 grand, about 23 grand. That's over 1,400 trades. That's a lot of trades, right? So your average profit per trade there is something like $15 a trade. That's not a lot, but it's enough to give you an edge if your commissions are reasonable. More importantly, you'll get a bigger edge if you're doing 10 to 1 plus leverage on the IWM and turning that $15 positive expectancy into maybe $150 on an option. So that's the kind of thinking you need to have when you're looking to grind out these kind of, maybe not home run trades, but steadier trades. That's what we're after. Nothing's going to be perfect, but we're looking for that greater consistency. That's what people tell us that they'd like to find more and more in this process. So you can see with the Russell, notice the Russell's been in a really choppy daily range. This is perfect for the Donchian channels. You can see we're tagging down into the lower Donchian channel, then we're popping up. Tagging into the upper Donchian channel, we're coming back down. And you can see how many turning points we've seen, including this turning point that happened here in late January, where you can see that it was starting to turn back up. It just barely went oversold on the 23rd, started to kick back up, and actually told us that's a nice opportunity to kind of got a little double bottom action there. You can see up that spike low on the 19th, and now we're starting to flip up again. And this is a great example where we don't have to hit a home run. We were cashing it out. You can see kind of the middle of the next day here around that 135 and a half range, maybe somewhere closer to this. And then basically that move was just about 1.5%, led to just under a 30% gain. So you can see pushing towards a 20 to 1, maybe 19 to 1 potential leverage in that example. So that's the kind of thing that will definitely get you in and out very effectively here. Okay. Now remember, Bill mentions, okay, how many commissions you might have to pay on all those trades on the stock, and that's true that you will over that in that case 16 years if you took every signal. And remember, part of what we're doing here, Bill, is that's where we started. That was just the daily chart. What we're doing, you can see, is we're actually filtering out a number of trades that we consider to be suboptimal, not ideal. So we're going to actually do quite a few less trades than that in any one vehicle. Even though we might, over the course of a month, pick out a couple of IWM trades, a couple of SPY trades, a couple of GDX trades, a couple of TLT trades, we're actually not going to do that about, what would that be, about 10 trades a month that averages for IWM. You see, we're screening out a bunch of those. So we're going to not only cut your commissions, but we're also going to use the leverage of options to further benefit on the trades that would do make the most sense. Okay, you can see more recently, IWM had popped back up here. It looked like it was starting to roll over, and you can see, look at how we were potentially giving a trigger to the downside. It would have been in this area here. You see, that was a pretty good 30-minute signal, but we didn't take it because we were below the prior highs there by about a half of a point. So we waited on that one and in turn missed a profit opportunity. I don't mind that. I point that out just to say, hey, the trigger part worked, but the setup part wasn't quite right. There's going to be times where if the setup's not right, the trigger might not even work. You can see on the 20th, it looked like we were triggering, but the 20th was still not quite below that prior low from a couple days ago. Okay, so that's why we had to wait, and it was a good thing we waited on that one. So waiting, patience is a virtue with this system, and that's what we're really about, is teaching you how to be a little more patient and how to just wait until, kind of like wait till you see the whites of their eyes in the Revolutionary War. If they had shot their muskets too early, they wouldn't have had the same impact, right? And therefore, might not have won the war. You shoot your capital off too early, without a strong edge, and you're probably not going to be around to win the war. So we're in this to make sure we keep you in the game for the long haul. Okay, now some of the strategy guidelines here to look for some more consistency here are, we want to usually go out to next week's options. There are weekly options on these four big vehicles, as there are on a lot of the bigger traded ETFs and stocks that go out, in this case, for many individual Friday expirations. If we got a signal on, say, a Tuesday or a Wednesday, the temptation might be to go use this current Friday's expiration with just, in this case, of course, just has one more day to go where we sit on this Thursday night. But if we were Tuesday or Wednesday, you might think you could get in and out quick enough. That will often be too close. So we'll usually go out to the next Friday, whatever week we're sitting in. So if we got a signal now, we'd be going out to next Friday. If we got a signal on Monday, we'd be going out to the following Friday typically. So from this perspective, we'll basically say, okay, this will give us a little bit of extra wiggle room, especially here where we're talking about buying an option. We sell an option, we might well be able to take advantage of the shorter term, faster decay of about a 3, 4, or 5 day option. But for this case, most of what we're going to do is looking into the next week to buy. This means we can be in and out in 2 or 3 or 4 days and still have some time left. So even if it does turn against us, we're going to be able to manage accordingly. With those 4 vehicles, we think we can certainly average at least 8, and sometimes that's about 10 trades per month based on the last 5 months of option buying experience using this same system that was working so and continues to work so well for us in the selling of premium as well. We want to keep our option premium somewhere in that $2 to $5 range, but more importantly, we want to make sure that option is mostly all intrinsic value. You saw in a lot of the examples I showed earlier, we were talking about pushing up to about 90% intrinsic value in a lot of cases, certainly at least 80% intrinsic value. That means that if you're sitting there waiting for this thing to move in your favor, it's not hurting you, but it's not helping you. You're not going to get burned by a bunch of time erosion. That's where a lot of option buyers have been burned in the past, and then they just swore off option buying because they bought the wrong options in the first place. If you buy the right kind of option, even though it's going to be a little bit less leveraged, it's going to keep you a lot more stable. So we're really interested in essentially your maximizing your return relative to risk. So more like a risk-adjusted return is going to be better with the in-the-money options, versus you might make more sometimes buying an at or out of the money option, but you're going to lose more the other times. That's going to make a more volatile experience. We want to basically reduce some of that time-based volatility and focus more on what's going on in the intrinsic value of the underlying and not have that option lose much time at all, okay? Usually what we're going to start a trade with is about a 20% stop loss and then on the option, and then we're going to have about a 40% full target. Now that 20% stop loss might sound like a lot if you're new to options, but remember, we're talking about $1,000 on a $10,000 model portfolio. You could be doing more or less, but we're really saying what that means is if you lost 20% on 10% of your capital, that's really only about a 2% hit on your overall portfolio. That's about the level that I want to keep my portfolio risk on any trade around a 2% hit. At the same time, if I can make a 40% full target profit, then I basically you just added 4 percentage points to your portfolio as a gain. So that's a 2-to-1 reward for risk. That's how you want to buy premium to look for at least a twice your benefit relative to your risk. Now, the intraday momentum filter trigger, I think is very unique because a lot of people just go in and take stabs off of the daily chart. But what we do is we say, look, the daily chart says one thing. Now we want to go in and see if we can validate it with what we're seeing on the intraday chart. You know, with the market breaking out to new highs today, both the S&P and the Russell are setting up for a potential flip back down that may or may not happen. See, if we keep breaking out to the upside, then we're not going to try to get into a bearish trade because we would not want to, just like you wouldn't want to catch a falling knife until it stopped falling, until it's got some support. You also don't want to sell a runaway train or rocket, right? You want to basically wait until it's showing more signs of stability. This helped us a lot in the period like right after the Trump election, where the markets just seemed to go up day after day there for a period of almost 2 weeks. So that was a great example where, you know, we're not going to be selling that market because it's just making higher and higher highs. That's not a range anymore. That's a trend. You want to be sure you don't get on the wrong side of the trend here. So that's what the momentum filter does really nicely for us. Now, I've coached a lot of traders over my 25 plus years, and I started Big Trends back in 1999. And what I find is that the people are at different levels. If you're new to trading, I would bet you're probably still having some challenges managing your emotions. If you're brand new to trading, you're starting to see that trading, you come into things look easy. It looks like, hey, it's a piece of cake to buy a quality stock or to buy a call option on a quality and make money, and then it's not working, and then you're getting frustrated, or that fear and greed kind of equation. Maybe the worst thing that I think can happen to some traders is you win big on the first couple of trades you ever do, and then you think, this is super easy, I should have quit my day job a lot sooner, and then you get your head handed to you because you haven't learned about capital allocation. That's why we always tell people, don't let your portfolio risk get more than about 2% overall, because that way you'll keep yourself from, you know, having a trade that basically knocks you out of the game. You know, that you want to basically stay with this as a growing your wealth more steadily over time rather than a get rich quick mentality. Okay, it's definitely about following a system, letting the edge play out over a larger sample of trades. So that's why as you move out of that emotions phase, you realize you better have something that you can rely on, not just kind of how you wake up this morning, what side of the bed you feel like you got out of or fell out of, you know, basically saying rather, you know, okay, are you really expert at a certain pattern? So that's what we teach a lot of traders, is how to get expert at this. And then it's about making sure you can execute that pattern consistently, because a lot of you, I think, are in this second phase where you've been coming to these webinars like what Steve has on the Candlestick Trading Forum for a while, or what I have, Big Trends, you know, basically constantly trying to sort of drip this education that Steve and I picked up over decades of trading, trying to really kind of get it into your head, but it can't all happen at once, right? It's a process, but some of you kind of not quite to that phase of kind of having the belief that you can do it with the kind of consistency, so you haven't like been able to apply it yet. You haven't been able to truly put it rubber to the road. And then some of you are there where you're actually doing this every day, and you're just looking for a little bit of fine-tuning on your edge. And if you are, then you're definitely on your way to greater consistency. And it's a lot easier, I think, when you get to this stage where you say, look, all I've got to do is execute my system. If I don't care anymore about whether the market proves me right or wrong, if I know that I'm following my system consistently. If you have trouble getting out of a trade when you know you should get out, that means you probably were too vested in being proven right in the trade. You probably have the emotional hang up still at the first stage there. And so this is a big one to break through. You know, just I'm not going to ask anybody to answer this. I don't want to put anybody on the spot, but think about this for a second. If you've ever been tempted, or worse yet, ever done this, where you've actually been in a trade that went against you and you actually averaged down on a trade, essentially what you were doing is you were trying to lessen the ego pressure that you were feeling of being wrong on the trade in the first place. And so by averaging down and cutting, say you put as much capital in the first time as you did the second time that you averaged down, and say you are at a 20% loss, you average in more, and now you're only at a 10% loss. You can see how that's just an ego deflection to try to soothe the pain and make it feel less bad, and then feel like something that you can stick with. You see what a mistake that is, to throw that kind of good capital after bad, that's essentially just trying to protect your ego that's basically bruised or worse. Ego is one of the most costly things in your trading. So we got to get you away from that emotion stage into a systematic edge, extracting the edge, executing the edge. That's what I'm here to show you with our ETF boot camp course. Now, and as I said, just the buy side of that in the last 5 months allowed us to go from 10K up to about a little over 13K, so about a $3,200 gross profit. And you say, well, that's only $500 a month, or $600 a month actually, over 5 months. But basically, you said that's not huge. But actually, you're talking about, say, a 5 to 6% return a month on a portfolio basis. You know, you start doing that consistently, you know, you're going to be up, and not even compounded in this example, you're going to be growing your capital at very fast rates on an annualized basis if we keep that up. Now, again, I don't want to promise that there's not going to be a down month or something. There will be. There's going to be times where you give back a little bit. But that's why we always say if you keep your risk contained, you can stomach that. Now, what I want to show you, I want to share this boot camp page we set up. You see that we got the link here. I know Chris will post it for me here in a sec at bigtrends.com/bootcamp. Usually, most people say, oh, I want in on ETF options trader. That's what I want. I want that kind of gain potential. What I want to do with you first, thanks for posting that, Chris, is I want to just educate you further, and I want to do this in the form of a boot camp that I have in progress right now that still has a live session to go. But because I've already recorded 2 of the 3 sessions where you could basically watch those and be ready for my final live ETF boot camp session here coming up this coming week, that basically you can have some time to start to let this stuff sink in over the coming days as you watch the first 2 archived hour-plus sessions. Now, let me go to that page and I'll show you what I'm talking about here. So basically what we're talking about is, let me go to this page, here it is, bigtrends.com/bootcamp. Now, usually this ETF bootcamp, the 3 sessions would be $299, but because it's Steve's group here, Steve's been really good to me, and you know, just I share a like-minded passion for giving you value for your education and making sure that you can start, you know, at a very attractive entry point, and then I get a lot of people essentially they get hooked on this stuff and want more from this. I'm knocking it down from the $299 down to just $99 for the ETF bootcamp, and this is lifetime access, folks. So what you get here is you actually, for the ETF course, you get the 2 sessions I've just archived here in the last 2 weeks. One I just did on Wednesday, yesterday. It seems like it was longer than a day ago, but basically a lot happens here at Big Trends every day. We did the best ETFs for market time and swing trading. We gave the settings for each of those big 4 ETFs. So when we actually showed, okay, how many days back we're looking at for the Donchian channels for each of them, what's the ideal stochastics for them, etc. And the first one we did kind of just basically the backdrop about all the key things you need to know about ETFs to be ready to start taking advantage of these big 4. And then the next live session, the final session where you can ask any questions live with me, will be this coming Wednesday. And this is where, if you're new to options or not new to options, you'll learn my top 2 option strategies, what my parameters are for buying an ETF option. And also what I haven't had time to talk about here today is how to sell options premium and start cash flowing these big ETF options as well. So all that's at your fingertips for just $99. Now, what you also see on here is that we've got another featured package that my team set up because I said, hey, do something special for the Bigelow group here. And so, one boot camp that's normally $299, just 99 bucks today, but actually we've got 9 total boot camps, and that's not going to be 9 times 99. We actually did all 9 in there, including the ETF one here that still has a live class to go. All the other 9 are now on-demand access, where you can also email in and ask me and my research team any question you have when you go back and watch any of these boot camps that you have access to. We give you a dedicated email to get your questions answered as a boot camp member. But when you do all 9, that includes the weekly options. So this is all the key things, including option charts, which is a real breakthrough eye-opener for a lot of people that have traded options and never even looked at an option chart before. Swing Trading Bootcamp has not just 3, but a bonus session on additional option and swing trading tactics, including a lot of case studies, scanning the markets, and more. And then CS is the credit spread essential, so key credit spread trading lessons and my credit spread trader strategy, doing credit spreads on stocks. DS is the debit spread, so you can do debit spreads on stocks and ETFs. And we teach you about whether you're day trade, swing trade, or position trade. Earnings-based strategies. We actually have 5 sessions in the earnings boot camp, including iron condors, including double calendars, a lot of unique option strategies, and even how to buy options once the earnings report hits. Had a lot of success with that here in the past month with a nice earnings season there as well. And then Donchian channels, we do a whole 4 session on Donchians, and then also a gamma class for a more aggressive option buying, and then a market timing class as well. So the reason I just cover all those, you can click on all those tabs when you go to bigtrends.com/bootcamp and review all those course materials. You can see over 9 different ones. We have some bonus ones. You've got about 30 total sessions. That's just 495 bucks. Usually, if you bought all 9 of them individually, you'd be up to something like 2,600 bucks. So basically, 2,691 to be exact. So let me just share that real quick, and then I'll come back out of that. Basically, you can get the 1 ETFs, the 3 ETF sessions. These are all lifetime access on all these boot camp classes, and that one gives you next week. I'm going to go through my #1 options buying strategy and my #1 options selling strategy live. So you'll be in a webinar-based format where you can ask any questions, and I answer everybody's questions in those live classes. Then we give you a dedicated email for all the other on-demand boot camps. Now, like I said, all 9 boot camps on the right, the best value, that would be $2,691 a total list value if you bought them all individually off my site. I'm offering to the Bigelow community for just 495 bucks. Now, and this includes a lot of other, you get the ETF boot camp, you get a lot of other stuff. Let me go back in here and show you how this works, okay? If you want just the ETF boot camp, hit the add to cart button. So what you'll see, and I think I might have it in there twice, I was checking it earlier, is that you can X out of one if you have 2 of them in there. We've already applied the coupon code from $299 down to $99 for the 1 3-session ETF bootcamp. You just hit the green checkout button, you'd be good to go. Okay, but the other super special requires you to click on the text below, anywhere where it says enroll in it with the coupon code Bigelow. Okay, you should know that last name pretty well, right? If you left click on that, we'll take the 1 ETF bootcamp off. The lowest we'd previously sold it here was $8.95 for all 9 of these. But if you type in Bigelow on that coupon code, in all caps, mind you, Bigelow, apply, guess what? That Bigelow name is worth a $400 extra savings for you tonight. You get to take it down from $8.95, and I'll honor it here over the next couple of days max, but no more than that. So basically, you got to act quickly on it. So basically, 400 bucks off takes it down to just 495 bucks. Obviously, there's no shipping charge, no taxes unless you're in the state of Kentucky. Okay, so I know most of you are not. That's a plus for you in that case. It's a beautiful state, but you save some money here. Just 495 all in. All you do is hit the green checkout button, and then what you'll see is down below it pops in our HTTPS secure website. We use one shopping cart. It's done a fantastic job for us, very secure. And bottom line is the bold information is what you have to fill out for your credit card to process. We do want to double confirm your email to make sure that you'll get your login credentials, whether you have the ETF classes or all 9 of the bootcamp classes at the best value. We take all your major credit cards plus PayPal, and then you can, if Chris, who's been in with to help answer, if he's helped answer some questions to get you started, you can click on his name. If you just saw it on the webinar, you can click on saw it on the webinar. Any notes you have for us, you can put there. And then all of our terms and conditions spell out how we do business. Like I said, I've been launched Big Trends back in 1999, so I've been around a long time, and we're real clear about how we do business through the terms and conditions there. Just click on that once you review that, and then hit the submit order button. Assume you got all your credit card information there correctly. You should be good to go. Make sure your credit card matches up with your address, which sometimes get people to forget that they put their home address and maybe they've got their credit card going to a business or a PO box or whatever. So make sure those match up. It's usually the biggest question we get when they don't process is an address mismatch against where your card's going. So bottom line is, let me go back and see if we have any other questions here. Okay. Rick says, with these all pre-recorded boot camps, how many are left is live? Like I said, all the in the 9 boot camp entire, what we call the regiment of the entire all 9 boot camps, all the other ones have been recorded already, but they're still very fresh. The ETF one is the most fresh because I just recorded these first 2 sessions last week and then yesterday on session 2. The session 3 on the ETF option strategies will be a live class this coming Wednesday. So you get a little time to start to soak in those prior couple sessions, get caught up, and be ready to go with my top 2, both my number 1 buying and number 1 selling option strategy this coming Wednesday. Those are done right after the market close at 4:30 Eastern time. So Steve, thanks also for posting that as well. So $99 for the one, that's still a 2/3 savings for the one class, and of course $495 against the just under $2,700 of total value for all 9 of them gets you down to more than 80% off, something like almost 85% off at just $495 versus about $2,691 of total value. And like I said, if you're worried about support, don't, because we give you a dedicated email. You can ask as many questions as you want about any of the boot camps that you have access to as you review them, and you get the lifetime access to them too. These are high definition quality. They're instant on demand available. You get a members site where you get to log in and you can click on them for your own benefit as much as you want. We just ask to use it for your own benefit, of course, and not share it with anybody else. This is information that, frankly, as I've learned over 25 years of trading, and so you're getting a shortcut to really the best of the best tools that you can use here. John D is asking, like, what's the period and offset for the channels? That's the kind of stuff that will be covered in the boot camp where you'll get those settings as a boot camp member. So you get all those details. You actually see the kind of back testing that we did. In fact, in yesterday's ETF session for those boot camp subscribers, I actually walked them through how to do the back tests and how we would rank them according to not just net profit, but also other criteria if you want to rank them by win rate, by average profit per trade, by even potential drawdown risk. You can actually rank them according to that kind of get that, increase your consistency and make sure that it's giving you your desired result. So are the boot camps on a specific date, or can they be viewed at different dates, Lawrence? They're already there waiting for you once you sign up. So basically, like I said, the only one that's not is the 3rd session ETF option strategy, which any new buyers here over the next 48 hours max will basically get that invite to be ready for next week's class. Okay, so you'll be ready to go, and then you'll also get the members access to go watch the first 2 classes, which are a little over an hour apiece. So you can soak that in, because it's not just the material I'm giving you. I'm also answering questions throughout that, and then you'll also get your dedicated email, so you can have unlimited email access to ask any question. David says, how long are the classes? They're right about an hour, or just over an hour in some cases. I don't like to make them less than an hour, because basically I find that while in these complimentary previews, usually people start tuning out about 45 minutes in. Basically, we find that when people have paid for stuff, they want to get that content and be able to soak it in. And usually with the questions as well, it's easily going over an hour each time. But we try to keep it not too much more than an hour either, so you can digest it and then go on to the next one as well. Date time in the next class, Rick says, the one on the ETF option strategies will be this coming Wednesday after the market closes, soon after, about a half hour after the close. And basically that will usually go on the options class a little longer than an hour. I would expect that'll go about an hour and 15 minutes, because we're not just covering one option strategy, we're covering a couple across all those big ETFs I mentioned earlier. Thanks, Chris, for getting the specific there. And so bottom line is that, yeah, we keep it really simple. Everything that we do here at Big Trends is meant to be knowledge transfer that you can really use. It's not a bunch of smoke and mirrors or a bunch of stuff where you're left in a fog. We want to make sure we keep you really clear about what we're seeking to do, what the edges are that you can take out of the markets, whether it's the ETF markets with the ones that I've given you an overview on here tonight, or whether it's the ones that actually, things that maybe you've been missing. Maybe you weren't aware about, some of the different earnings strategies you could use with options in front of an event, or how to trade them after an event and still manage your risk. Maybe you weren't aware about some of the turning points in things like a Donchian channel. It's pretty cool when you go in and look. Just I'll give you a little taste here real quick. When I did my Donchian channel analysis, the first security I ever looked at on the Donchian channel was the Dow Jones Industrial Average. Why? Because in TradeStation, I was actually able to go back, not just the usual couple decades or so, I was able to actually go back 90 years. That actually means that I was able to go back and look at something that took me back into the 1920s. And you say, well, why would you want to do that? And one person asked me recently, I said, well, wasn't that irrelevant back then? I say, hey, it's obviously a lot more relevant happening now than what happened 90 years ago, but it doesn't hurt your confidence if you see something that's worked through all kinds of markets across a bunch of different decades. Does it? I hope it doesn't, because for me, that's the kind of thing that will really create a lot of confidence. So, for example, when I go and show you that particular system here real quick, I'll just give you a little taste here. Okay, so basically if I look at that system, and this is in TradeStation, mind you, so basically I'm looking back, and you see, and this system has been just buying the dips on the Dow when we get an opportunity, and I'll usually sell, even though that one took a stop there in the summer, I would actually sell some out and book some profits when it hit that upper Donchian channel. So I've got some ways I've managed and take some short-term profits regardless. But this is what I want to show you. This strategy performance report goes back 90 years to 1927. You say, why should you care? Because look at how well it does overall, even though there was one time where it looks like it was kind of had a rough drawdown. Most people will focus on that, right? I know most of us are creatures of exception. We don't just care about all the good times it worked. We care about the one time where it didn't. From about 2000 to about 2002, remember, that was the end of a 20-year bull market. You say, oh, well, this must not work well on bear markets. Well, actually, some of the best profits it ever made was in the fall of 2008, where things went straight up into the middle of 2009. That was some of the best equity curve gains the system's ever seen, as it caught that downtrend in every bounce, with shorting those bounces. Now, bottom line is that you see that looks pretty good. What looks even better to me, again, past performance is no guarantee of future results, and these examples are hypothetical because you could not actually trade the Dow Jones Industrial Average, especially more than a decade ago. Once DIA came around, the DIA actually is a trading vehicle that you can use. I'll show you that here in a sec, just to show you that it transfers into that ETF as well. But the SPY tests even better than DIA. Bottom line is, it made money across all the trades, and you say, yeah, sure, the long or bullish trades should make you the most money over the last 90 years. It's been a generally bullish market. But I thought what's really encouraging is it also made money on shorts. Yes, the win percentage wasn't as high, but it still made you money, which tells you that when you're wrong, you're not wrong for long, and when you're right, you get a lot more bang for your buck. So that's what helps that equity curve look good and actually not get hurt through periods like, say, the crash of 1929. You see that basically you didn't give back too much. Give back a little in the 30s, but not too much. Not like the 80% haircut that buy and holders took in the Great Depression. Okay, you think about the crash of '87. If I go back to '87, there's '87. You give back a little, but not nearly the kind of crash, even from the peak equity of 120 to about 90. So that's a 25% loss. Well, basically, guess what? That the stock market dropped 22% in a day and dropped a lot more from peak to trough in '87. So the point of this is that you can take advantage of this and really benefit from it over all kinds of market conditions. The other thing I was going to mention too, I just promised you, wasn't expecting to go into this kind of detail, but had a couple extra minutes, wanted to show it to you. What about the DIA? Guess what? It looks very similar. The DIA has only been around since 1998, right? So now we're going back almost 20 years. It has that same kind of drawdown from 2000 into 2002 I was just showing you. But guess what? Overall, been up. You see, it gave back a little bit here in recent times. But you know what? What's impressive? It's made almost as much money in shorts over the period as it's made in longs. The win percentage in shorts is actually better on that particular 2-to-1 reward to risk. He said, that's not a high winning percentage. I could tweak it to make it a real high win percentage, but you know what? I can make money even with a low win percentage with this system if I make bigger profits and keep my losses smaller. So there's all kinds of ways to take money out of the markets. All you need to know is that, frankly, it starts with educating yourself properly. For some of you, that means supplementing the education you've already had with Steve. I know Steve teaches a great deal about candles with the T line and the trend, as well as with the reversal patterns on candles. And we try to do the same thing. We're really basically not just trends here, but reversals with things like Donchian channels, and the that's one of the boot camps in the total boot camp course. But you'll learn about Donchians too in this ETF Essentials program as well. That's a big factor we like to use for the big indexes and big ETF plays here. So just a reminder, like I said, all you got to do is go to bigtrends.com/bootcamp. And let's see, a couple other questions I might have missed here. Buffett, don't lose money. Rule, I think it was what? Rules 1, 2, and 3 are don't lose money, right? I think protect capital, and protect capital are his top 3 rules, right? So very good. And so, yeah, definitely, Rick, take care of your sweetest on the day before, so you've got all the time you want on our boot camp day on the 15th. Very good. Lauren says, do we focus on the indexes, those big 4, only in boot camps, or do we cover any other options? In the other boot camps, Lawrence, that I was showing you earlier, for example, the swing trader is more about stocks. The credit spread trader strategy is a stock-based strategy. We do use credit spreads on indexes too, but basically that one's about stocks. The debit spreads focuses on stocks. So there's a lot of stock-based stuff in here. Individual earnings, of course, are stock-based. So you'll learn about a lot of different individual stock-based strategies through the boot camps. The gamma strategy is also stock-based. So much more stock-based actually than index and ETF based, but we do have the index and ETFs covered as well. Okay, let's see also, does the equity curve have one setting for Donchian channels? The equity curves for each of the big 4 ETFs I showed you were based on different Donchian channel upper and lower boundaries. So you'll learn that in the ETF course. It's not just one setting because we tried it with one setting like I showed you on that Dow example, and that's where we started. But then we said, why, if we're going to focus on these top 4 for the ETF options, why not go ahead and use the best of the best ones? So we'll walk you through how we came up with that in the strategy testing class that I just recorded yesterday, plus the gamma, or I should say that's the ETF strategy class there on market timing and swing trading yesterday, and then the ETF Essentials class from this past week, and then this coming week's live class on the how do we implement that with the real world ETF option strategy. So I'm coming up on basically my hour here, so I want to say thanks for being with us here in the Candlestick Forum here over the last hour. Like I said, Chris Sayre has been posting the link here, bigtrends.com/bootcamp. And at bigtrends.com/bootcamp, you can review that. You've got the choice, like we said before. Just get the one to get started. That's fine. Just $99. It's a great value. It's 2/3 off. Of course, it's more than 80% off when you get all 9 of them for the $4.95 with that coupon code Bigelow. We've already applied the best pricing on the ETF Bootcamp itself. $99 is as low as I can go there. But to get the even lower, take it from $8.95 down to the $4.95, just type in Bigelow in all caps like we showed you earlier. Remember, if you came in late, all you do there is you just go over here. Let's do it again here real quick and say, okay, if we go ahead and say, I've got to add it back here 1 second, that all you do is you click on that text, left click on the text, enroll in the bootcamp regimen, or left click on the name Bigelow, and then all you got to do is just type it in over here. So it might remember that. The other ones I show you don't apply anymore. Those are old ones, but basically this one's fresh. Bigelow gets you $400 in extra savings. So thanks, Steve, for that one. So again, I'm going to let you go and let Steve and his crew go as well. It's always a pleasure being with you, and I'll hope to see you again in the very near future. Steve, I hope to see you at one of the upcoming live events. I know Steve and I have presented at a lot of live events together. It's always a pleasure to see him and learn from him as well. So you can call Chris Sayre at our 800 Big Trends toll-free number. He's posted there for you. And a link will be sent out, as Jim mentioned, via email to all the members tomorrow. So if you came in a little late, make sure you check it out. I'm headed to go watch the Duke-Carolina game. Don't tell me the score. I'm a Duke graduate, so if you're a Carolina fan, I'm sorry, but basically it should be a great game. Have a great night. We'll see you soon. Trade well, and I know you'll love the boot camps, whichever way you go, with just the one for the 99 bucks on the ETF, including the live class next week, or all of the 9 for just the one-time savings, extra 400 off, 495 total price point, thanks to Steve and our great relationship. Take care, everybody. Have a good night.
Price, thank you very much. Always good stuff. So
Thanks,
everybody,
Steve.
if you've looked at Price's information, the thing that keeps us going together, doesn't sound right, the reason we do a lot of business together is that Price has excellent information, number one. Number two, I often say you get more than your money's worth on quite a few people, but in Price's case, you get well more than your money's worth. And on top of that, he doesn't teach you or show you what you need to learn. When he teaches you, he's making sure you do learn it. And he's got service or the lines to call that if you ever have a problem, they are always there to help you. So you get good service, you get good information, and most important, you get well more than your money's worth. So this is the type of information that if you're going to trade successfully, you need to have all this in your trading arsenal and your knowledge. So Price, we greatly appreciate you being here. It's always good information. So with that, everybody have a good evening, and I don't know how Duke's going to win, but I hope they do. All right, everybody, have a good evening.
Thanks, Steve.
Yep.